Okay, welcome everybody. Thanks for joining. In today's video, I want to talk about the stock market. It's gone down a little bit, and you guys know what that means. If you've been in the stock market for more than a day, and you've been following this stuff on social media and on things like YouTube and CNBC, you know the drill. CNBC will be talking about the huge market sell-off the entire day. That's all they're going to talk about. They're going to bring on expert guests, and those guests are going to say how they've been predicting this the whole time and how some investors are going to get wiped out and yada, yada. There's going to be a lot of panic on their website. It's going to look like this. Lots of red. You know, these lines going down, the Dow Jones selling off. We have the Dow Jones in the red, the S&P 500 in the red, the NASDAQ down 2.5%, even a breaking news banner that the treasury yield has gone up a little bit, and it's unnerving investors. We're unnerved, right? The NASDAQ can go up 50% and nobody cares. But as soon as it goes down 2.5%, time to freak out. Time to come out with the YouTube videos with the big red thumbnails of the keywords, stock market crash, market sell-off, shocked faces, looking into the camera, completely stunned at the stock market, and then fire in the background. That's the type of thumbnails you're going to get today. That's the type of content you're going to get today. My message for you is to relax, okay? Relax a little bit. It's okay. The stock market goes up and down. Your companies are completely fine. They were fine yesterday. They were fine the week before. They haven't changed that much. The companies you're investing in are okay. Look at their businesses. Are they going out of business? Most of them, no. There's not many companies going out of business right now. Lots of them, in fact, are having record sales. They're growing their businesses. They have good residual income, solid income. They're not really reliant on the stock market to perform well. A lot of these companies are fine. So breathe a little, relax, ignore the fuzz, ignore all the noise in the background, and look at the companies you're investing in. That's the first message of today. When you see these type of these days in the market, it's easy to get wrapped up in the news. And if you're new, you get the impression, I should probably be panicking right now. That's what people are telling me I should be doing. I'm looking at this news and I should be panicking as a result. That's the feeling that you get. When you get red, that's a normal thing in our biology to be alerted by it. That's a color that alerts you. It says it should have your attention here. There's something important going on. Not really. The stock market does two things. It goes up and it goes down. That's what it does all the time. Over long periods of time, it typically goes up. That's usually the case, and that will probably be the case going forward. And of course, we can see this point illustrated on every graph. Today, the S&P 500 is down 2%. We zoom out to a month, and it's down not really at all. It's pretty flat for the month. We go to 6 months. The S&P 500 is up 11%. So in half a year, we're still up 11%. You go to 1 year, and the S&P 500 is up 23% in the past trailing year, and that's including the coronavirus right here. That's including a pandemic. The stock market's still up even with a pandemic, but yet we have this one day where there's a little bit of a decline and people freak out. And you can see the same thing with the Dow Jones or the QQQ, even the indexes that are getting hit harder. The ones that have gone up further likely have a bigger drawback. In fact, we can look at ARKG here. This is one that's been hit particularly hard, 6.6%. That's a pretty sizable pullback. That's not a meaningless pullback. But again, we can zoom out to 6 months. In the past 6 months, it's up 52%. So should you be panicked about this? If you're invested in ARKG, not really, not in my estimation. You're still up if you've been invested in this for like longer than a day. If you invest in ARK, their flagship ETF, the same thing. It's down 5% for today. Should we be panicked? Well, you look in the past 6 months and it's up 44%. So the point is, if you're panicked about today, if these type of events cause you to become unnerved, as CNBC puts it, then you have not set up your investments correctly. You haven't done the research, you don't know the risks involved, and you haven't set up your portfolio correctly. And my advice would be to reassess your investments and maybe move to a more conservative-based portfolio or learn more about how investing works over the long term. Now, what I want to do in this video here is I want to go over my portfolio and give an inside look of how a real portfolio performs over days like today and weeks like this week. My portfolio has also been hit by this recent downturn. Does this cause me any type of anxiety or unnerving at all? No, Not a single bit. I know very well the companies I'm invested in, and I have no problem if they go down in price. Many of them I'm really hoping that they go down in price. And I do not say that kind of like tongue in cheek or joking. I am very much hoping that a couple of these companies get hit really hard unnecessarily by the market so that I can buy them at a much cheaper price. Because there's some good companies here that I want to make much larger positions, and I'd like to do that at the cheapest price possible. Now, if we look at some of our holdings, let's filter by the 1-day view here. So far, we are down 3.6% for the day. So maybe a little bit worse than the NASDAQ for the day. We're down a little bit more. The S&P 500 is down like 2%. We're down 3.64%. Not down quite as much as ARK funds that are down like 5 or 6%, but still quite a bit of money, $2,400. That's quite a bit for the day, right? If I go down, I can actually look at the specific holdings that are down the most or the least. The ones that are down the most is Teladoc. That is it's kind of a speculative play, but it's I would describe Teladoc as like a Zoom for medicine. It's like the way that you can communicate to your doctor and actually have appointments with them without having to go to the clinic, which I think is the future. A lot of the unnecessary visits to the clinic are going to be solved by Teladoc. So that's one I'm actually bullish on. It's a smaller holding, but this one's down 11% today. That's a big drop today. That's $300. Then we have Spotify. This is a great example of a company that I was very happy dropped today. This one I put $1,000 in just today. I did an alert on my Patreon and on my Discord because I'm seeing Spotify drop. I'm going to buy this company. I think that Spotify is one of the best opportunities in the market right now. Next to Netflix, next to Google, and a couple other companies I think will do exceptionally well, Spotify is one of them. And I plan on coming out with a video next week outlining my entire bull case on Spotify. So that is one that I'm very excited is dropping. I hope it drops 10 or 20%. I would really be excited about that because Spotify is not dropping 10 or 20% subscribers. They're gaining 24% premium subscribers year over year. This company will be a massive company in 10 years. I'm very confident of that. So if I can get it at a cheaper price, at a smaller market cap right now, I think there's just more upside in the future. Then we have Tesla that's dropped a little bit. This is a very small holding. I only have a few $100s in it, and most of this is gains. So if I actually look all time, Tesla is like, I think almost 100% of this is gains at this point. So I took out my initial investment. Then we have Peloton. Peloton dropping 6% is like, that's like a slow Tuesday. Peloton goes up and down 5 or 6%. It can run up 20% in a week or down that much. It's a very volatile company. It trades at a pretty high multiple, and the company's growing super rapidly. Like super rapidly. So when you put all those factors together, that makes a very volatile holding. Do not hold on to Peloton if you want slow and steady growth in a company. That's not what this holding offers. So Peloton is one that I remain bullish on. I realize that there's a lot of short interest in this stock. A lot of people think it's overvalued. I don't think so. I think it's a pretty incredible opportunity. I wouldn't put my life savings on Peloton, but it's one that it's one that I think is worth making a significant bet and putting it at like 3 or 4% of my portfolio. Then we have DocuSign. This one is a mostly business to business cloud e-signature company. They have some other tools. They're trying to expand out of just being cloud signature, but that's basically what the company does. And they're very well known for it. If you work in any type of corporate environment, it's likely that your company signed up with DocuSign. So they're growing really rapidly as well. DocuSign is one of these companies, again, that has many competitors that have replicated the product, but for whatever reason, DocuSign just has kind of become the de facto. When people talk about signing documents, a lot of times they just say, can you DocuSign this, right? It's almost become a verb in a way. So DocuSign is one of the holdings I have right now. It's ran up a lot. So this one I don't think is the best value right now. So this one probably is due for a little bit of a pullback. The same thing with Shopify. This company has always traded at a very high multiple. It still remains at a very high multiple. It's such a good company though. This one I do not plan on selling. I don't care how much this trades down or up. I don't really plan on selling Shopify anytime soon. This is one that I could easily see holding for the next 5 to 10 years. So that's one also fell 4.6% so far. Now, we have a lot of other companies that fell. Most of them are in the red. I could go through all of them, but I want to highlight a couple that are in the green right now. Actually, it's just one. Twitter is the only company in the green right now. And it actually was up a lot this morning. It was up 10%. But then as the general market fell, Twitter went down from being up 10% to down 6%. So it kind of fell from its huge bump up. But Twitter is becoming a company it's one of those ones that traded flat for since it IPO'd 4 or 5 years. And now it's starting to actually make some specific decisions to help monetize the social media company. And they're doing that, I think, not through just offering subscriptions, but I think they're going to have kind of like a tipping portion of Twitter. So if you really like a tweet from somebody, you can tip them like $1, or you can unlock some exclusive tweets or something for some type of money. They're going to have some type of monetization built into Twitter. And they just recently, I think today, announced that they're going to have a goal that by 2022, so 2 years, or by the end of 2022, they're going to double their revenue. That's a very ambitious goal. I don't see how they accomplish that just with advertisement. So I think they're going to open up new venues of monetization. So that's why Twitter's up so much today, is they have been more creative in the ways of monetizing their company, and they're setting more ambitious goals than they have prior. But other than that, that is basically my portfolio right now. And again, if we look at these companies that are in the red today by quite a bit, like at least 3 or 4%, they're in all different industries. All of these are in different segments and industries. They have different customers and different risks. We have cloud computing companies. We have Netflix and entertainment companies. It's down 2.8%. Google's down. They have YouTube. We have the gaming industry down 2%. Spotify's down 5.8%. That's one that I did buy $1,000 of to take advantage of this dip. And then we have CrowdStrike down, cloud security company, Salesforce, a cloud CRM for businesses. Every industry, Amazon, online retail, Teladoc, technology, healthcare company, basically every industry is in the red right now. And it's not even just technology companies. Again, going back to this, we have the Dow Jones down, we have the S&P 500 down, and we have the NASDAQ down. What this means is that this is a broad market sell-off. It's broad. It's not concentrated to any one company or one theme of investment. It's a very broad sell-off. And when that happens, that means that people are indiscriminately selling companies. They're selling X, Y, and Z without looking at any reason why they're selling it. They're just selling out for whatever reason. Typically, it's the result of index funds. People pull their money out of index funds and ETFs, and that means that they sell hundreds of companies at once without even realizing it. If you sell the S&P 500, if I go and I sell $20,000 of it, I just sold 500 companies. I don't know which ones were really worth selling or keeping, but I just decided to sell all of them. So when this type of thing happens, it's an opportunity. You can look into your portfolio and see what company was the victim of this broad market sell-off that really doesn't deserve to be. What company just went down in price for no reason? To me, that's Spotify, that's Netflix, that's a lot of these companies. A lot of these companies don't deserve to be sold. I think Netflix is undervalued. I just outlined a whole case of why I think it's widely undervalued. So anytime it goes down in value, to me, the disparity in value is greater. The bet on the company is more safe. My margin of safety increases as it goes down in value, and I make additional purchases at a lower price point. That's what I'm seeing with these type of companies. I'm hoping that Netflix goes down in value, and that Google does, and Spotify does, and Salesforce, and Amazon. That would be fantastic if I could buy these companies at a larger discount, because I already think they're discounted. If they go down in value anymore, that's just widening the disparity between what I think they're really worth and what they're being traded at right now. So I view this as a big opportunity. I'm going to be looking at this portfolio, and I might make some more trades by the end of today. I'll announce it on my Patreon and Discord if I do. But if I see some companies really start to sell off dramatically, I will be making more aggressive buys. Now, the next thing I want to bring up is how I plan on growing this portfolio over time and my goal for 2021. Like I said, I want to get this portfolio to $100,000 in value by the end of this year. That's a goal I set, and I plan on keeping it. Right now, my automatic deposits into M1 are already set up. So I have this feature right here. This is on the transfers tab of M1. You can look at the rule-based system, and I have 2 schedules set up. I can show this full screen. One of them goes from Ally Bank to my M1 spend account. That's M1's checking account. And that happens every single week on Monday, and that's $500. Then I have another transfer set up from Ally Bank to the Story Fund. That's my growth portfolio. And again, that's $500 every week on a Monday. So right there, I have 2 automatic transfers every single week on a Monday that automatically takes $1,000 out of my checking account and it puts it into my brokerage. It puts it into M1 Finance. And then that money is out of sight, out of mind. I'm not going to be spending it on cars or vacations or anything because it's already at my brokerage. And I'm not going to take money out of this. So I already have that systematically set up. And what that does is it helps me grow this portfolio faster. Because if I have automatic deposits set up every single week, I don't worry about what the market's trading at. I just keep buying stocks over and over again. So that's the first way that I plan on growing this to $100,000. Hopefully, I'll get some gains along the way, and that could bump me over the $100,000 mark, but that's no guarantee. I don't know how the market's going to do this year. I'm very confident in the next 10 years, but nobody can project out such a short timeline. I don't know how it's going to perform in 2021. So if it doesn't perform good, and let's say the opposite happens, and this performs very poorly this year, and this 8,000 in the green turns to 8,000 in the red, or $20,000 in the red, we have some huge sell-off, that will be a huge opportunity. I'll still try to get this to $100,000, but now I'll be buying companies at a much cheaper price, a much bigger discount. I'll be buying Netflix and Shopify and other companies at a much cheaper price because if I'm in the red, that means the price of my companies has gone down, which enables me to buy them at a much cheaper price point. So that is my goal for 2021, to get this portfolio over $100,000. In doing that, I don't pay too much attention to these red days. If anything, I take advantage of them. So ignore the type of noise that you see that causes people to panic and causes you to be fearful. It happens on social media. It'll be on the Facebook groups where people discuss investing. It happens on Reddit. There's a lot of discussion on Reddit about stock market sell-offs. It happens on YouTube. It happens on CNBC. It's happening everywhere where people panic about the stock market. There's no reason to. Just relax, take it easy. Your companies are going to do fine. Anyway, I appreciate you guys listening. If you want to discuss more on the Discord, check it out. There's a link in the description. See ya.